Number one is make active income more passive for tax purposes, because that can save you up to 15.3%.
And how does someone go about doing that?
They choose the right type of corporation. They pay themselves a little bit differently. They have, if someone owned a commercial property their business was in, they charge the top dollar rent for that. It comes in with less self-employment taxes, or a couple examples. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Do you have money that's yet to be taxed from your business and wondering if you should pay the tax, or if there are investments that provide tax advantages? I'm not talking about merely kicking the can down the road, and just delaying taxes. Tons of people can do that. But ways to actually save tax without just spending or blowing the money. I call spending to save tax the tax tail wagging the dog. It doesn't make sense to spend $1 to save 37 cents. I mean, is it best to just pay the taxes now, delay, or find ways to permanently save? You'll know after today's episode how to permanently save. All right, Stolba.
This is going to be a good one. Sam wrote in with a question.
Cool.
But before we dive in, I was going to tell you, I started reading a book called Buddha's Brain. It's phenomenal. So if you haven't read it, or anybody out there, it's well worth your time. But speaking of nerding out on things, I realized how much I nerd out on neuroscience, like brain chemistry. Like, it is so fascinating to me. So I've been thinking a lot of thoughts after.
Because you're trying to understand my brain. And
I'm trying to figure you out. After work.
Neuroscience can't explain it. What?
Oh, but it's so fascinating. Just, how we have so many, there's been talk around, if you have one negative experience, there's so many positive ones that you need to counterbalance it. But it's just so fascinating how our bodies and our brains are just wired to focus on survival and protection and safety, even if we have positive experiences.
And how often does that happen in money?
Right. Yeah. And I was trying to cross over the worlds into our conversations here. So many people do have fear around money, or there's scarcity, or they're looking to make their life safe and secure. And it's just but
many times going about the wrong way of doing it, where it's either limiting or governed by scarcity, or actually because they're going for status or opportunity, too risky.
Yeah.
Or they're going for preservation or accumulation, very slow, very tedious, very, problematic on how they live their life. So,
yeah. And I guess the hopeful thing is we do have the capacity to rewire our brains and our associations.
I tried it all in the past, was a miser, penny pinching. Then I was a conservative when it came to my, retirement thinking, which was I'm just going to put as much money, saving over 50% of my income and every different type of retirement vehicle and maxing all of them out. And then I eventually got to be like a striver, which is about more and hustle and scale. And then the most damaging one was when I was a high roller trying to do all these deals and not doing enough due diligence, or relying too much on other people, and getting, over 100 real estate properties and doing oil and gas and having a hard money lending fund. And it consumed my life, and it consumed holidays. It consumed trips. And it was never the things I wanted to work on. It's just what everyone else told me I had to do.
Yeah, we can get ourselves into tricky situations when we're listening to voices outside of ourselves.
Yeah.
Easy to do. Okay, so here's Sam's question. Where should I invest my business profits to avoid taxes for the year? Should I keep it in the business after paying taxes, or invest in buying a new office or some other asset? So what advice would you give Sam?
Okay, so a couple things here. One is, if you're an LLC or S corporation, it's known as a pass-through entity. So you have to pay tax whether you use the money or not, whether you take it out of the business or not. But there are some ways to retain earnings inside of a C corporation. So just something to keep in mind. Now, as far as just putting money away in order to save tax, the biggest mistakes people make, they set up simples and SEP IRAs, and they set up, traditional IRAs, or even defined benefit plans, which are where you can put a lot more money into it, but they're very expensive and even more restrictive. All of these are tax deferral plans. And so if we look from 1944 to 1981, the top tax bracket was over 50% that entire time.
Wow.
We've got 24 trillion and more coming into the national debt. And so I think there's a chance they're going to raise taxes in the future. So what happens if you defer taxes, number one, and the tax brackets go up? Number two, what if tax brackets remained exactly the same, but 10 to 20 years from now, you're making a lot more money? which hopefully just because of inflation, you're making more money. Now it means that you have more dollars taxed at a higher rate. Therefore, less that comes to you to spend. So inflation actually becomes an issue if we don't change any tax brackets. But there's also the risk of taxes going up because of uncontrollable spending that the the government is doing, so that's something that we have to consider. But answering the question, where could you put the money? Where could you put the money? And so obviously if you invest in things that are beneficial for the business, but they have to make economic and fundamental sense first, tax benefits second. Okay. If we go make a tax decision like, hey, I'm going to go spend this money. Like I met with someone on an immersion like a year and a half ago. I guess it's coming up on 2 years in this December. Crazy. And they bought a new Ferrari every year. I was like, you really into Ferrari? He's like, no, but I need to get a write-off. I'm like, well, this isn't the best way to get a write-off.
Yeah.
Because does it depreciate after you buy it? Are you buying it new? Are you getting a lot of use out of it? You're paying for insurance on it. Like maintenance on those types of cars is quite a bit. I said, would you do it if there wasn't a tax benefit? He said, probably not. And I said, okay, well, let's look at other strategies. Let's look at other strategies. And by the way, we just see that the New York Times came out with a report on Trump's taxes, and he's done a bunch of things that we've talked about for years: conservation easements, historic easements. I mean, you can kind of see there's actual legal ways to navigate it. And I don't know if everything he did, I didn't read the whole report or anything, so I'm not making a judgment on the whole thing, but I'm saying there are things we can legitimately do. So one is if you were to invest back into your business, maybe you need to buy equipment, maybe you need more space, maybe you're hiring an employee. Yeah. Like if there's anything that has to do with people, processes that support those people, automated procedures and technology, those could be essential. And if in his business that we're asking here, Sam might have R&D credits if he built a website and used people in the United States, or if he modified an app, or if he has a CRM that he's improved, there could be R&D credits that can help offset this without having to spend any money. Or if he goes back, there might be net operating loss things that he could take, which means it usually is caps to 80% where you have operating expenses for your business and you can't write off anymore once you get to a certain point.
Okay.
But the rules have changed because of the CARES Act, where you can go back and say, well, let's match that to a year where I had really big income and take the expenses back and write it off against that bigger income. And I can go up to 100%, no longer capped, and you go back and amend. So that would be another example of things that you could do.
How many years can they go back and amend for that?
Well, typically you could go back 3 years, but with the CARES Act, you have a chance for time to go back to 2015. So and you can kind of match up high earning years with high expense years, because sometimes businesses make major investments in infrastructure or something like that, and they limit what they could write off. So that's another thing that he could do. I would just be really careful about deferring taxes. I'd be looking more for tax deductions. And so there's a simple framework. One is you want to build the right team, and there's up to 4 people on the team. One is just someone to get you your data on time. That might be a part-time bookkeeper. It could be a full-time bookkeeper, depending on the size of your business. It could be a controller that's actually helping with payroll and other things. Or it might be a CFO if you're big enough that's doing pro formas and projections and looking at margins. The second person on the team is a tax strategist. Yep. Now, I want you to make sure they're not a historian, but a strategist. If they just tell you after the fact what you owe, or just to defer taxes, that's a historian.
It's good clarification.
If they proactively help you navigate the taxes and how to maximize deductions, that's a strategist. The third is an attorney. So that attorney might be a corporate attorney for a small business or a tax attorney for a larger business, because now you want to choose the right types of corporations that minimize your tax with things like self-employment tax. Or in Sam's case, maybe choosing a different election on his corporation might change how that's taxed, and you might not have to go and spend this right now to save on tax. And the fourth one is people that have commercial property might want to get an engineer for something called cost segregation. Yep. The second thing to look at with taxes is maximizing your deductions by doing 2 things: documenting everywhere you spend and asking, does it relate to the business? If it does, talk to the accountant and see if it could be a write-off. Yeah. Most of the time it can, not everything. Then the third area is reclassification. So I've mentioned it a little bit, but there's 4 ways to do that. Number 1 is make active income more passive for tax purposes, because that can save you up to 15.3%.
And how does someone go about doing that?
They choose the right type of corporation. They pay themselves a little bit differently. They have, if someone owned a commercial property their business was in, they charge the top dollar rent for that. It comes in with less self-employment tax. Those are a couple examples. The second is turn ordinary income into capital gains. So if you do business internationally, you can set up an international sales corporation and take all that money through your international sales corporation. It comes in as capital gains, which could be 0, 15, or 20% instead of as high as 37.5%.
Okay.
So the third thing would be tax-free. So if you're selling a business, there might be ways to sell it tax-free. If you're into charity, there might be things that you could do in relationship to the charities to avoid taxes through charitable trusts and things like that. And the fourth one is tax arbitrage. Tax arbitrage is rather than spend $1 to save 37 cents, you spend $1 to save more than $1. So there's a few strategies. I mentioned conservation easement and historic easement. You got to be careful with these types of things. There's plenty of people not doing them right. There's plenty of like weird ways that they're doing it, but if you do them legitimately, it's ethical, it's legal, and it's just fine.
Yeah. Would you consider your artwork investment a piece of that?
Yeah, that's an arbitrage where I bought a bunch of artwork. I displayed it for years, and actually I just donated more this year because we turned one of our guest rooms into my wife's office. Yep. So donated all that artwork, but we literally bought it and displayed it. It was all over our building that we sold back in the day, and then moved in the new building, didn't need all the artwork, donated a bunch of it, but I was able to buy major collections at discounts. And then when I've owned it for 3 years, I can donate it for the full appraised value to museums. So that would be an example. Yeah. So there's plenty that can be done here, but be careful with deferring and only buy what you would have bought anyway. Have economics and fundamentals first, and then look at the tax advantage second. And, you know, I've given you kind of a bit of a tax framework. Now, for some resources, you go to wealthfactory.com/tax. In exchange for your email, you can get a report and you can get tax ideas, and you can talk about how you can hire your kids and all the deduction stuff that we didn't cover today. And we can kind of build a relationship that way. So wealthfactory.com/tax. What's funny about tax? Nothing. But we might as well figure it out so you can keep a lot more of the money you make without tipping this partner called the government. Click here to find out more.